Hey everyone, welcome back to Chip Stock Investor. We're back for your daily dose of moderation regarding the market.
That's right. The last video, we tamped down some of the extreme bullishness on Nvidia, but now we need to, I think, kind of lift things up from some of the extreme bearishness surrounding Nvidia and the whole AI data center infrastructure build out thing too. Some pretty egregious claims being made, like really, really serious claims being made.
Michael Burry was at it again after Nvidia earnings, sharing the now, well circulated circular relationship chart that claims that the whole AI thing has few actual users and that it's a house of cards ready to implode. These claims are very serious. We're talking like the biggest fraud in human history type of serious. And the market is having a pullback, which seems to add some credence to these claims.
NASDAQ's down about 8.5%. Some worry that maybe this is just a total fraud. And what you're looking at here is the same revenue among the big data center companies and the AI startups just being recirculated over and over again and being counted over and over again using equity financing to fuel the AI data center build out. I think, Casey, to start with this, we'll just, I guess, maybe ignore the fact that the biggest majority of NVIDIA's revenue comes from the hyperscalers, and they're using NVIDIA's hardware for their own internal workloads, which is real revenue generating business, very, very profitable business. They're getting return on investment. We'll just ignore that fact, I guess, going through this discussion when talking about this being an AI fraud.
And maybe we should just touch on the fact that the whole economy is circular in a way. Just for illustration purposes, here's our semiconductor industry flowchart. We use circles for a reason, and you can see that the flow starts at the top, but ultimately goes through the economy, ends up going back to the top. The companies eat their own cooking.
It's actually quite common. This is the bedrock of how economics work. You take a product or a service, you transform it, and then resell it for a higher price than what you bought it and the cost of transforming it for, hopefully for a profit, ideally, obviously. Here's another way of illustrating it. For those of you that work deep in the business world, you probably know all about this, but even with saying this is all like a big quid pro quo deal, I'll scratch your back if you scratch mine type of thing. I think a lot of investors maybe, I guess, don't realize how much money changes hands in these small little eddies, these little circular agreements, especially in new technology industries. New users tend to be a very tightly knit network of early adopters and other fellow high-tech companies. And as these early users and adopters work with the new tech, the seller of the tech improves on it, the usefulness of the tech improves, costs get driven down, and then this little ring of early users gradually begins to expand beyond that original little ring into other areas of the economy. Along the way, it's really about all who has the most efficient operation and can hold on to that cash that moves back and forth. And so there is risk here, and especially at this magnitude, we're talking about hundreds of billions of money changing hands to build out these AI services and the infrastructure needed to operate them, trillions of dollars of equity value that investors have in companies like Nvidia. So the magnitude is much larger, and we will acknowledge, yes, there is risk here, but calling it all a fraud is literally just a very big misunderstanding of how Silicon Valley built itself up until this point. By the way, before we continue, check out chipstockinvestor.com. That's where you can find a lot of resources, a lot of our research, and where you can join Semi Insider. You can join our community of like-minded, long-term mindset investors. And we have a new web app where you can read all of our research, and we're building out supply chain tools to help with a lot of the research that we're talking about today.
But what about NVIDIA's use of equity to fund customer spending on its own product? That's one way of looking at it, but here's another way. We have listed the definitions of debt versus equity financing. Debt or credit agreements, like those comparisons to the internet infrastructure of the late 1990s, is a very different agreement. Remember, debt requires lump sum repayment plus interest payments, but no sharing of business ownership or share of future profit. So under credit funding agreements, what the seller gets in return is cash for products sold plus interest, or nothing if the customer flops. How is that different from equity?
Yeah, this is another thing Silicon Valley has been doing for a long time. Equity, it's an entirely different form of capital financing. Funding a customer via an equity investment really changes the dynamics of the future upside of the agreement. The payoff isn't payment for product plus interest. The investor's payoff is obviously eventually they would get payment for the product, but they're investing in a higher order product or service that has been bought and transformed into something that can be charged more for later on. Remember basic economic principles here. And oftentimes what Nvidia has been investing in is those higher order products that use its equipment. So their hope is not just to fund competitors like Core Weave. We'll get to that here in a minute because there's a good reason why Nvidia would want to fund and invest in a company like Core Weave. But a company like OpenAI, the hope is OpenAI takes the AI infrastructure and generates orders of magnitude more revenue and hopefully one day profit with that AI infrastructure, and Nvidia gets a cut of that versus maybe just selling the infrastructure equipment on credit and in the hopes that they get the money back plus interest. So you can see the difference in risk to reward profile via these types of deals. Now, because it's such a tightly knit ring of companies that are seemingly financing the whole thing via equity, perhaps there is some risk that there's no return on investment down the road. That's the big question. And I think that's the nervousness out there. Can OpenAI actually start generating enough revenue to pay the bills and eventually turn a profit? So we're not saying there's no risk here, but this is essentially what's happening. There's two ways to fund a new venture, debt versus equity. And if you're Nvidia, a company like Nvidia operating at this scale with this much cash and cash flow coming in, as a shareholder, you would expect them to invest in their core product and core services with that cash. And if they're right, if there is that much runway ahead for all of this AI infrastructure, equity is a much better way of financing all of it in the long term for Nvidia, simply going about selling product on credit.
And this kind of debunks the this time it's different argument, right? There's never really been a company quite like Nvidia operating at this kind of massive scale with so much liquidity at their disposal. So it makes sense to invest that cash. So if Nvidia is right about all of this, why wouldn't they want to invest in the future industries that they're helping to create? And also the hyperscalers are actually the biggest customers of Nvidia. Don't underestimate that. In fact, this is from Nvidia's latest 10Q. You can see that their direct customers, which include some of the hyperscaler companies, actually make up about 60% of their sales in the latest quarter.
Hyperscalers, or the companies that manufacture the servers for the hyperscalers. And you mentioned Core Weave a moment ago. This is one of the reasons why Nvidia is so incentivized to fund some of these competitors to the hyperscalers like Core Weave. Nvidia knows it has revenue concentration risk, and it behooves them then to make sure that competitors to big tech survive so that they have future revenue from many different sources. Revenue diversification is a big deal, especially for a company that gets this large, and Nvidia doesn't have that luxury yet. I also find it odd that everybody complains about the big tech monopoly or oligopolies, and then we have a company here trying to help break down that oligopoly, and like some of us are still not happy about that. because the methods are foreign to us, I guess. Kind of strange to me. That's why Nvidia would want to invest in these companies via equity to make sure that they survive, and they would like to be vested in that company's success along the way. Seems like a pretty normal expectation to me. Does it bear risk? Of course, all investing bears risk.
About those companies, the OSATs, the ODMs, the OEMs that actually take the NVIDIA components, assemble them, and sell them to the hyperscalers, this leads us to yet another risk or bear thesis that has come up in recent weeks about the accounting from NVIDIA, their change in the way they report those sales. You may start to think that we get all of our information on X. All of our research comes from X.
It doesn't.
It doesn't. But this is where a lot of this stuff is popping up. So we will show you exhibit number 2. And just a pet peeve of ours, a lot of these posts always end with something like, oh, there's so much more to the story, or just wait and see.
Oh, it's just the tip of the iceberg. I like that one.
Just spill it. If you have something to say, please enlighten us.
Especially if you're claiming this is like one of the biggest frauds in history, write the report, just come forth with it. Get on with it, to quote Monty Python. Now, I think we probably do want to acknowledge here for sure that in the 10Qs and NVIDIA's 10Ks, they have made this change in the definition of the location of their customer. Before they were saying basically, as is very common in the semiconductor industry, they were registering the sale and the location of the customer based on where it was built. So a lot of the OSATs and OEMs and ODMs are in Singapore. And so the claim was before that all this revenue going to Singapore, that's like illegal revenue that's headed for China. I'm sure some of these servers are probably making their way past the trade restrictions and into China, but that's just where a lot of the OSATs and ODMs are that assemble this stuff for NVIDIA. They're located in Singapore, Malaysia, Taiwan. And then they did make this change, though, where they're now reporting the geographic revenue by where the actual system winds up, which is obviously mostly in the US for the hyperscalers. And I think there could have been a much better job explaining the situation, but I guess that's why we're here, though, right? This is actually a topic that we've discussed numerous times. Here's a slide that we created this time a year ago, actually, addressing a question about why Qualcomm in particular has well over half of its revenue going to China. And it's not that the revenue is all going to the Chinese market. Obviously, Qualcomm chips end up all over the world. The thing about these accounting, the way NVIDIA used to report its accounting and now the more recent change, this is actually quite common in the semiconductor industry. The moment the chip goes out of their control, it gets sold to a manufacturer, a device manufacturer or a circuit board assembler. That's where they record the sale. And most of those manufacturers and assemblers are in Asia. And so that's why it looks like companies like Qualcomm or Broadcom have these very, very high revenue recognition sales going to China in Southeast Asia.
So NVIDIA used to report when the chip left their possession, they recorded the sale. Now they're reporting where the company is headquartered at. Now, of course, all that being said, if there is any credibility to these claims, this is a risk for NVIDIA.
Yeah, these are serious charges. So write the report, write the full report. I don't want to hear any more. This is just the tip of the iceberg and be strung out. If you have some serious claims to make, just spill it.
And while we're talking about NVIDIA risks, let's just throw one more out there for you to think about: fast rising inventory over and above revenue growth. Let's look again at the latest 10Q.
I think the concern here is typically when you see a very fast rise in inventory, 19.8 billion in inventory value at the end of October for NVIDIA. At the end of January this year, it was just over 10 billion. So nearly double the increase in inventory. And so typically when you see a big jump in inventory like this, it would oftentimes be like a yellow flag that perhaps a company is facing an imminent slowdown. But there's a big however that needs to be considered with this inventory value.
There is some additional detail that NVIDIA gives us. Notice we have highlighted work in process, meaning unfinished goods and materials. And that seems to make sense with NVIDIA's claim that it has 500 billion in Blackwell and Rubin orders starting from the beginning of this year through the end of next year.
Yeah.
All that stuff getting finished up for shipment.
Over on Semi Insider, we have additional write-ups and research on this topic. And we talked about, based on the outlook that's been provided, we're looking at something like perhaps $300 billion in Blackwell and Rubin sales in calendar year 2026. If that's true, and these are difficult numbers to try to grapple with here for a company that just a few years ago, many investors knew very little, if anything, about. But if that is true, you could argue 20 billion in total inventory at the moment is probably not enough. So this is not an issue that concerns us at this time.
I think it's important to remember that we're not writing all of these risks off. We do agree that these are risks. There could be some truth to any of these claims, but we're trying to look at this very logically and moderate. And ultimately, we've been pretty clear on what the real risk for NVIDIA is. NVIDIA's main customers, as we said, are the hyperscalers. And eventually, those hyperscalers are going to stop spending gobs of money. And when that happens, we're going to have a down cycle on our hands. Make sure you check out Semi Insider over on chipstockinvestor.com. And if you haven't seen the latest two videos, we'll link them here at the end of this video. The truth about depreciation and NVIDIA's earnings update. We're here to help you clarify what's actually going on. So check it out, and we'll see you all again soon here at Chip Stock Investor.